Interest rates. So as of today, we have more jobless claims. Unemployment is going up. Inflation seems to be under 3% right now, still not at the 2% target. And this is like a moving target because we'll get one set of data 1 week that will move the needle that doesn't give the Fed as much confidence that they can cut rates. But here in the last week to week and a half, there's been plenty of data out that would suggest that rates are going to go down. So the Fed projected 2024, they would have 3 rate cuts. Right now, there's about a 50-50 shot that there will be 2 rate cuts. Me personally, I don't think there's going to be 2. I think there's going to be 1. And ironically, I think it's going to come right around the election time. So some are saying, yes, we're going to see, they usually do it in quarter basis points, so 25 or 50 basis point. So what is priced in is a 44 basis point rate drop, which is technically impossible, but it's just the way the averages work in September. So rates are going to go down. And this is really cool for our business because especially with this business model we've never been able to execute this business model in a reducing interest rate environment. It's always been an increasing interest rate environment. So we have honed our skills and perfected our strategy in the midst of increasing inflation and increasing interest rates. So we're actually super excited to run this model and these new strategies when we have external factors that actually work in our favor now versus against us. So yeah, you thought it was cool to do our strategy when prices were high and interest rates were high. Well, we're about to get the cherry on top with lower rates.
Are HELOCs lower rate than mortgages?
It's a mixed bag. It can be higher and it can be lower. This is where marketing, branding, and government control can indoctrinate people to have these myths and misconceptions about things. And the reason that it comes that way is if we could rewind time prior to 2010, prior to 2008 or 2007, when you said, what are mortgage rates? You'd be like, I don't know. It's anywhere from this to this. Why? Because it was a maze. You had subprime lenders, you had prime lenders, you had different guidelines. This lender over here could have a different rate than this lender over here for these reasons. They could go to this LTV versus this one. This one could structure it this way. It was so different that if you asked that question 15, 20 years ago, you'd be like, dude, it depends, right? And nobody likes to hear the answer depends. But here's the reason why we have now been trained to think a certain way is mortgage rates are all now uniform because it's government controlled. So, when you talk to a lender now, whether you're in New York, California, or Florida, the rates are going to be very, very similar, within a quarter point of each other, right? So the only advantage of choosing one lender over another is relationship and service. That's it. HELOCs are still the way mortgages used to be. So yeah, you could have some banks that have high interest rates higher than a mortgage. You could have some that are substantially lower, like being a promo rate. Heck, we know one bank up in Delaware where they have a 5-year fixed. And that's another thing. People also assume that interest rates on HELOCs are higher. They don't have to be. They could actually be substantially lower than mortgages are. Not lower than what they were in 2020, 2021, when you had 2.75% mortgage rates. But, there are intro offers out there that are down there. But anyways, back to my story. We got a bank in Delaware. They have a 5-year fixed HELOC. So that's the other assumption too, is that people think that HELOCs are all variable because the big name banks, all of their HELOCs are variable and all of their HELOCs are tied to prime. There are HELOCs that are tied to different indices, whether it's prime, LIBOR, T-bill, 6-month T-bill, COFI, SOFR. Heck, I'd like to see one tied to crypto, but anyways, it's still the Wild Wild West because this is a bank-owned asset and they can do almost whatever they want in structuring their own product. And the big box banks can have high interest rates because they have the brand recognition. You're still going to do business with them by and large. But the community banks and credit unions who do need your business are getting creative and coming up with cool ways to get you in the door. And so they've got really competitive products that can be variable, fixed for a certain period of time, or hybrid, where you can have a portion of your HELOC be variable and another portion be fixed. So, to answer your question, hate to answer it this way, it depends. You just got to know where to look. Fortunately for you, we know where to look. So the other thing is, we also, back to one of the videos we were talking about where you have to execute critical thinking. When you say, aren't interest rates higher on a HELOC? Let's go back and ask the question, why do you care? Maybe you do, maybe you don't. But why do you think you care what the interest rate is? Because you've been taught that that's what matters most. The interest rate is what matters most. I'm here to argue, it would be great to have both, right? But let's just assume that we can only have one or the other, high interest rate or low interest rate. When it comes to simple interest lines of credit and executing our cash flow strategy, time and balance are far more important than interest rate. So when you say interest rate, it's because every time you've done a real estate closing, it's been on a mortgage, and you've been focused on what the interest rate is. That's what the loan officer told you to do. That's what the marketing is telling you to do. Anytime they're advertising on TV, what are they saying? Interest rate as low as this, APR this, right? They have to throw APR in there because that's the lowest number to sell, because you're equating to low interest rate as cheaper, when in fact a lower interest rate could actually be far more costly. I would rather have a 9% HELOC than a 3% mortgage. The reason being is the HELOC, I'm allowed to do a lot more with my cash flow, therefore reducing the balance. And when I reduce the balance, I reduce the time. And when I reduce the time and balance, I reduce the amount of interest I pay. So we need to focus on rate of interest, not interest rate. So it's really, you have to ask yourself why you care about interest rate. And if you think you care about interest rate, then I would encourage you to look at your low rate mortgage and pull out the third page of the loan estimate, and it's going to have an acronym on there called TIP, total interest percentage. That's what's going to tell you what your total interest is that you're paying on that loan, and it'll shock you. And we've never helped a customer structure a HELOC where the TIP was higher than a mortgage. It's always substantially lower. It's usually half, if not a fraction, of the TIP of a mortgage. That's real dollars out of your pocket, or real dollars in your pocket that stays in your pocket growing for you. That's what we should focus on, is the total we pay, not how much we've baked into our monthly budget.